Reid Hoffman will be here in about a minute, but we're going to start. And it'll be the same format as the other panels I've moderated, where we'll start off by asking questions, and we'll have a discussion, and then we'll open it up to the audience. So let me introduce the panelists first, very quickly. Rebecca Arbogast is a managing director at Stifel Nicolaus. Stifel, thank you. She focuses on legal and regulatory issues affecting communications industries, including spectrum, wireless, intellectual property, antitrust. She was also, at one point, the chief of the International Bureau at the FCC. I'll read in a second. So we have Chris Marangi, who's associate portfolio manager at Gabelli Funds, and for Gamco covers companies in cable, satellite, and entertainment. Laura Martin is a managing director at Needham & Company. She's a senior analyst for entertainment, cable, and media. She'd also been with Drexel Burnham Lambert, Credit Suisse First Boston, Vivendi, and her own firms, Capital Knowledge and Media Metrics. Reid, who will be here in a minute, everyone knows from yesterday's fame, so I don't think I really need to reintroduce them as co-founder of LinkedIn, partner at Greylock, yes, and an investor, as he said, in Funny or Die, so responsible for much of the time I've wasted at work and other places. Now, I think we'll start with Rebecca. We often hear in the policy debate people talking about what the effects of broadband and IT are on the economy, and there's lots of debate over how valid some of those studies are and what that means. And I think it's very hard to try to measure the effects of something like broadband on something as big as the economy. But Rebecca's been thinking about this from a different perspective, which is what is the effects of the macroeconomy on investment in broadband and IT?
Okay, thanks, Scott. When Scott asked me to be on the panel, and my charge was to talk a little bit about how policy affects the markets, which is basically my bread and butter of my day job. And as I was thinking about that, a lot of the policy issues, the impact on the industry, the impact on the markets, some of them are quite substantial. A lot of them are fairly incremental. And what I was thinking more about were the macro policy issues and how they affect industries and how they affect markets. And one of the, which I increasingly think are very profound, and was just noticing as I've been reading over the last few weeks a few pieces that I brought to share with you, and then I thought I would flag a half a dozen or so of the more closer to home policy issues. There was an article by James Surowiecki in the New Yorker a few weeks ago where he is talking about the new normal, which is the increased role of government. And he starts out by talking about an election that was in one of the German states and a speech that was given by Merkel at that point, which hey.
Didn't tell me about changing the time.
Yeah. You out of your pajamas?
Yes.
You were scared.
That too. Intimidated.
And so after this campaign, the American stock markets went haywire over the next 24 hours, and people's 401ks plummeted. And so his comment, his analysis was that this kind of volatility isn't going to go away because we now live in an environment that's dominated by what economists call political risk, the uncertainty that businesses face as a result of government actions. And he cites the CEO of the bond giant PIMCO, Mohammed El-Erian, who sent a letter to investors saying that the new normal is a world in which the public sector plays a much more influential role. Investors then are being forced to read the minds of policymakers, not something that they're good at, which is fortunate because that's why I have a job. And so bringing it the next step down, a closer level to home, we all talk, and we'll talk more among the other people on the panel about what some of the threats and opportunities are to broadband and to cable and telcos. But I think at a very high level, I think the biggest threat to the TMT, ICT sector is that we won't have a broad base of employed, educated people with disposable incomes for a while. And I oftentimes think of a statistic that I heard Blair cite to as he talked about some of the analysis they did in the broadband plan, that 40% of households once you take out the basic obligations they have for their budgets, 40% of households don't have discretionary income. That is a problem in many respects, but one of them is that will be a drag, I think, persistently on our ability to continue to grow this sector. And I think some of the thoughts I've had on that is that the policies, the macro monetary government policies that lead to income disparities and that shift resources from domestic education, which is something that Odilini talked about last night, and research, basic R&D research, to homeland security, military spending, and that fail to bring into control the costs of Medicare and Medicaid, I think are going to be a profound problem in our ability to both push out adoption and deployment of broadband. So a couple of writings that I noticed, that this is my second grade book report here, but that struck me that I wanted to share with you guys is there is a new book out by Raghuram Rajan, who has written a book called Fault Lines, and he's a finance professor at University of Chicago and was the former chief economist at the IMF. His book argues that the global economy is vulnerable to another implosion, and his street cred that he has is that back in 2005, so 3 years before the fall of the global economic markets, he told a meeting of global central bankers that the global financial system was compromised and was facing a full-blown crisis, and he was roundly criticized at the time. So in his new book, he identifies what he calls 3 fault lines that he sees as still present and very threatening to the global economy. The first is rising income inequality in the United States. During the last bubble from 2002 to 2006, the top 1% of Americans got 2/3 of the gain in the national income. Stop and think about that for a second. I mean, that is really a staggering statistic. And he points out that prompted government policy for easy credit, which was able to spur consumption, and that was accompanied by foreign dependence, particularly Japan, China, Germany, on US consumer demand. So his first fault line is the rising inequality of income in the US. And then the second fault line is how that shift, because of monetary policy and because of increasing export reliance in other countries, led to a massive trade imbalance among countries, which is what he identifies as the second fault line that still persists. His third fault line is something I won't take the time to go into, but talks about 2 different versions of financial systems and how there's global investment interaction between these 2 different versions that lead to a lot of instability and that have shifted a lot of developing countries to export-led growth, which have in turn, he claims, created a reliance on the US as the demander of last resort. So his proposals are some political and financial reforms, particularly making big financial institutions easier to break up, which he argues would enhance market discipline and create better risk management. And then secondly, improving education so that Americans can earn a living wage that will reduce the political and the economic pressure for a lot of monetary stimulation. So that's Rajan's thesis. Another piece that I noticed recently that—
How do you feel about that thesis?
I tend to agree with it. Yeah, I think it's something we should be taking seriously.
So it should be easier to break up big institutions?
I am not the expert on that, but I think that something that creates a better set of incentives for risk management is absolutely necessary. Whether the answer to that is breaking them up, I don't know, but something to control risk management, I think it has to happen. David Stockman, now this is a blast from the past, who, for anybody who's too young to remember, he was Reagan's director of OMB. He published an essay recently criticizing his own party's economic policy, and he made 3 main points. The issue that he was the most concerned about, not surprisingly, was the growth in the public debt. And what he pointed out was that if the public debt is honestly reckoned with to include municipal bonds, as well as some things that are baked into deficits that are baked into 2015, our US debt levels will reach $18 trillion, which he says is comparable to the Greece-style 120% of GDP. So he's looking ahead to a world in 2015 where our debt levels will be equivalent to Greece, which he blames on continued growth of the Medicare, Medicaid, Social Security system, tax cuts that were done primarily under the Bush administration, and 2 wars. that were not properly funded. So that's his first area of concern. His second, which echoes Rajan, is increased income disparity in the United States. His third is the unproductive expansion of the financial sector. I can't go that far with him. So I part ways with him on that. But those, I think, at a macro level are the issues that are going to be, we can talk all we want to about net neutrality, and we will in these other issues, but those macro level issues, I think, are quite profound and will be with us and are something that we need to be, cognizant of. Very quickly, 5, 6 points much more closer to home about how policy is affecting the markets and is affecting the industry. The first, and I think as we all know, we're aware that there's a conversation that goes back and forth between companies, the industry, the markets on the one hand, and the government on the other hand. And so they're constantly affecting, shifting each other. I think some of the things in the market that are affecting what the policymakers are concerned about. The first one is looking at the market structure. I think that at a very high level, the structure of the broadband network providers is quite stable. We all, those of us who have been doing this for a while, lived through a period where there was a lot of talk about a third pipe to the home, a fourth pipe to the home. I think there's a general acceptance that right now we're going to be in a duopoly in the wireline broadband market, and looking at wireless as a disciplining force, but wireless, as Blair pointed out in an earlier question, wireless is primarily dominated or likely to be dominated by Verizon and AT&T, which are one of the two duopolists in the landline. So a stable market structure in the network provision, but everything else in absolute total chaos. So that's the first issue. The second issue is convergence, which we all, have been talking about forever. I started legal practice at Wilmer Cutler and was doing European work, went off to do other jobs, came back 10 years later, and people are still talking about convergence. But it finally happened, and it shifted from the cable bell convergence to then the structure of edge versus net. But I think more recently, as everyone recognizes, the convergence has happened so that we now have Apple and its allies and Google and its allies is sort of the dividing line. Third, wireless broadband. Mary Meeker has put out a piece that predicted that within 5 years, the majority of people will be accessing the internet over mobile devices. That creates a lot of opportunity. It also creates a lot of obstacles for government policy to make sure that the necessary inputs are there. The fourth is over-the-top video, which is very disruptive. I think it's exciting to some companies, but very disruptive to others. It reminds me of, there was a piece in the paper about in California, because of the recession, there were these vineyards who had these wonderful grapes that they were letting just die and freeze on the vine because there wasn't a demand for high level wine sale for a while. And so these vineyards were looking at ways, a lot of social media, Facebook, different ways to be able to advertise their harvests and their wines. And so it was a big piece on how the internet can help the winemakers. But the one thing that struck me, and I thought it was a crying shame that these wonderful grapes were dying on the vine, but what they concluded was that, in short, Napa's winemakers are in the throes of a classic market disruption. They can't go backward, and the way forward is still largely unknown. The only certainty is that they can't stay where they are. So I think that there's a lot of coincidence between what's happening with the winemakers and what's happening with video distributors because of over-the-top. The last two are the ad shifts that have gone from...
They could just drink themselves to sleep at night.
I thought about that. Is shifting from mass advertising to targeted advertising, which raises obviously a lot of policy issues for privacy and has a lot of direct economic impact on some antitrust issues. And then the final one is cloud computing, which everybody, I think, is still trying to understand what the implications of that are. I think, very significantly, it's going to relate to privacy, to cybersecurity. A couple people at the privacy panel yesterday talked about how there's a lot of potential risks for the kind of privacy that Google and Facebook might be violating, but every day there are massive risks to the security of the network and the relationship between cloud computing and cybersecurity. And so when that massive attack happens, will be a day of, I think, a lot of reckoning.
Chris, let's, sorry. Chris. Let's look also, a little more narrowly. How do you, how do you see policies affecting investment in the companies you cover and their future?
Yeah, so let me take this a little more micro and talk about, I think it would be helpful to throw out there the bull case and the bear case as we see it for cable. And I'm going to talk about cable because that's where we're invested. And I think for rightly or wrongly, cable stocks are more affected by what goes on in Washington, the net neutrality debate, than the telcos are. Our firm we manage about $28 billion, which is totally insignificant, but we've been heavily focused in TMT for a long time. 30 years ago, not me, I was in second grade, we were investing in cable stocks for two reasons. One, they were subscription businesses protected by local video franchise monopolies, and the hybrid fiber coax was a better mousetrap. And of course, the local video monopoly has fallen away with the literal ascendancy of the satellite companies. But through prescience or luck or both, the cable operators invested in the network and have extended their competitive advantage.
30 years ago, that was a big risk.
Oh, absolutely.
People saw that as a big risk.
Absolutely. They've invested in the network and extended the competitive advantage of that network, which I'll just say is not necessarily synonymous with monopoly, to the point where they have the lowest cost per bit, fastest network in all but the 18 million Fios homes. And what does that mean? What does that mean to us? One, it's a hedge, we think, against whatever evolution there is in the media business. Reed talked yesterday about not being able to pick, or being very difficult to pick content companies. I find it just as difficult to pick what content will play and what won't. But they're all going to require pipes into the home. We're not even sure about how the video business is going to evolve. I personally think that pay TV penetration in this country has peaked, probably peaked last year. But again, the fact that the cable companies own this pipe into the home means that at some point, there's some inflection point where they can replace the video profits with broadband profits. And in fact, cable vision is now making more operating income from broadband than from video. And I suspect the rest of the industry is there or will follow. The second thing is that there's tremendous option value in the broadband pipe. I think if you put anybody from the industry or from Wall Street on a lie detector machine and ask them, whether they thought the voice business was going to be as big as it was, they would say no. I don't think anybody would have expected that, again, Cablevision would have more voice subscribers in its footprint than Verizon. And that narrative, that bull case for cable, however, is reliant on the cable industry, the telco industry, the broadband providers having price and pricing structure flexibility in the future, including the ability at some point to go to usage-based pricing, which is something I haven't heard in these 2 days, but probably something worth talking about. The bear case for cable, on the other hand, I kind of summarize as the 5 O's. Overburdened consumer. Again, Rebecca talked a little bit about this. Overbuilders, and I apologize, that's not a fair characterization for Fios and Uverse, but I needed to know. Over the air, which is wireless, over the top, Hulu, Netflix, and overeager regulators. And I think Wall Street rightly has been preoccupied by the latter two. And I want to emphasize that net neutrality is certainly not the only regulatory issue we think about. Blair maybe can explain to me what all of it is at some point for the 10th time. And a deal, and a broadband, a net neutrality deal or legislative solution, won't make that issue go away. This is a regulated industry. It's something, regulation is something that we all think about, and it definitely impacts investment in the industry.
Is it sort of a first order concern?
Absolutely. It is, and I've written this, I've said this on television, absolutely my first issue.
Laura, I know you have very strong feelings about how Washington and policy can affect investment and different types of investors, and how or whether it creates advantages and disadvantages.
Right, and mostly I just want to fight with Reed. That's really why I'm here. So the first point I'm going to make that I hope Reed just jumps all over is that what I think Title II does, which is ill-advised, is it takes a stand against one set of entrepreneurs for a different set of entrepreneurs. So in 1940, with enormous risk, Brian Roberts' dad at Comcast, Ralph Roberts, took every penny from the little belt and shoe company, and he started digging trenches. And every single franchise, when he finally got a cash flow positive, he bought the one next door, and he bought the one next door, and he bought the one next door, and he protected his franchises, as did Cablevision, as did John Malone's boss, whose name escapes me. But anyway, all these entrepreneurs built these businesses by digging trenches and laying wires and slowly building an ecosystem around content. But today, they're all billionaires, or they've sold out and they're at 100 million mark. And so here's a set of accomplished entrepreneurs who delivered to us a $65 bundle of 300 television shows, or channels actually, that each of us, there's 85% multi-channel penetration. And the government says, oh, no, even those are the privately funded networks, and I lived through rate regulation where the stocks were all down 50%. I've lived through the throes of capital investment. We're going to now take that away from you, put it under Title II. You know, we think we might not regulate your price upside on modems, but we might. We just can't be sure. And because we really want to protect this nascent Silicon Valley entrepreneurship, the VCs, the limited private equity guys, the angel investors, that they are more important to us than these accomplished entrepreneurs that used debt and equity markets to fund over the last 6 decades a really robust and successful television, high-speed modem, voice, innovative kind of products. That's what I think, and that's why I think the government should stay the hell out of markets. So, Reed, what do you think?
I'm happy to reply if you like.
Well, before you do, just let me ask one more question. We tend to think of creative destruction as a good thing. It's something that keeps us productive, keeps us sort of renewing our economy. How does that argument fit into what you're saying?
It's market-driven creative destruction, I think, is what we value.
Well, and I think that the time frames, I think one of the things that's been, I view, is missing a little bit from the conversations over the last 2 days is this concept of time frames to me is really important, because in the new economy, time frames are literally 6 months. I don't know if you've noticed, but you kind of have to buy a new Apple device like once every 6 months. But my old economy companies, they actually budget in years. Disney does a 1-year plan with a 5-year strategic plan. And every year, they change their capital budgets. And they don't change them. And so neither does News Corp, neither does, these big companies have to move in 1-year timeframes. I feel like the government moves in 5-year timeframes. So the concept that the government is going to do something useful that helps the internet, which thinks in 6-month timeframes, is flawed to me. It's an underlying flawed conception. The government cannot keep up, because my old economy companies can't keep up, and they at least think in years.
So Reed, from the venture capital side, and the idea of building brand new things, how do you? I mean, you talked a lot yesterday about how how you approach Washington when you have to, and thinking that it's more important to engage in DC in policy issues. So how do you respond to that? Do you think government often tries to tip the scale? Should it? And how do you balance the sort of the old economy companies versus the new ones?
Well, I think the real the central argumentation issue comes down to how much is the net and the data stuff equivalent of a utility or a public utility. And the question is, if so, then what the incentives are. If you don't think it is, and you don't think that it has a potential for kind of stifling public good by trying to extract rents through a kind of a privileged position, then I think most arguments, most rational people tend to go to a free market. Since I tend to think that it's much more like a utility, I get down to the question of, okay, part of the reason we have regulatory thinking on utilities is a question of, well, what's the right, one, kind of anti-monopolistic effects, and two, kind of what's the right industry incentive that we want. Now, in terms of the argument about one set of entrepreneurs versus another, one could, make that argument in the case of any utility and just say, well, these entrepreneurs, you're disprivileging them. So I don't think it's that. I think it's actually more on the question of, the same kind of basis that we have utility regulation. And that doesn't mean, utility regulation doesn't mean that you shouldn't have profits, right? That's not the point of it. Now, the question is, where do you direct the incentives? And I have two concerns in the net neutrality debate. from a civic perspective, and this isn't really from a venture perspective. I can just invest in software and a bunch of other stuff. So if suddenly, a set of decisions makes it less able for me to invest in one set of things because they're less attractive prospects, that's okay. I've got other things to invest in. This is more of a government civic thing. One of them is, we have one of the things I think is interesting about the internet industry is the U.S. is, by far and away globally dominant. And I think that part of the reason that we've gotten there is because we've had effectively in place something equivalent of net neutrality. And the worry is moving away from it. Because this is an outgrowth of the point that I made yesterday, which is about 50% of the interesting internet companies, and even the new wave, it's higher, are all in Silicon Valley, in the U.S. And as in terms of global internet, we're very dominant. And that's because of this trajectory that we've gotten to. And I think that one of the questions is maintaining that kind of global dominance. The second thing is, how do you have new entrants? I think it's very important. By the way, I have similar worries about platform companies within the technology software industry. If they quell new entrants, then we quell innovation. And so you have to be careful about that as well. It's one of the reasons, why I think, why I'm on the board of Mozilla, because making sure that there's diversity in the browser platforms allows for more innovation and a faster pace. And so that's where I think, in my view, the arguments come down to. And I guess there was one last point that's probably useful to make. Frequently, in the discussion of incentives, the incentive that is most described in terms of pipe investment, whether it's cable or telecom or anything else, is an ability to raise revenue. I actually think that one of the incentives that actually, in a utility context, that the right way to structure is to reduce cost in order to create more of an open platform across it. And if you have that open platform, you then create more innovation. And there's various ways to try to implement that as an incentive versus the other. And I guess one kind of side paradox that I think is interesting, and it's part of the reason why the mobile, like we've seen this growth in mobile, is, and I don't think this is a counter to my point, but I will bring it up anyway. One of the things I think was very helpful for beginning to tip the direction, the innovation in the smartphones was Jobs' ability to essentially initially enforce an all-you-can-eat data plan on AT&T, because basically said, look, we are going to allow all of this, like essentially equivalent of an open platform for the apps, to do this. And of course, that put a lot of strain on AT&T, and now they're kind of grandfathering the old and doing a new and that sort of thing. But it's an instance of when you have an open platform, what kind of innovation can happen. And so when you have a utility context by which we are thinking about how do we maintain our global competitiveness and what we're doing, it's one of the reasons why consideration and preserving something like net neutrality, and I'm largely in favor of Julius Janikowski's thinking, is a good idea, and that's the return fire.
Let me ask you a couple of questions before opening up a little more. With the utility argument, utilities, there have been lots of different ways for regulators to try to induce utilities to lower their costs, price cap regulation, for example. But it's generally done under the assumption that they're not dealing with innovation, and that the utilities generally are not thought of as innovative entities. Now, whether or not you think, so I guess the question is, do you think that means that the infrastructure providers either do not or should not innovate? How does that innovation part fit in?
Well, it depends on where you're deriving innovation. So, and by the way, I think it would be a terrible idea to like regulate all aspects of like cable companies or other things. I don't think that would be a bad thing. The principal thing I'm focused on and competitive of is thinking about the network as a platform. Right? That's the principal thing that I'm kind of given a bunch of thought to. Now, that being said, any kind of ability to move the financial needle is a provider of innovation. And I actually think that one of the things that is a good thing for us collectively is to have that incentive be, how do you have as much as cheap data as possible, right, in terms of data bits, right? And so I don't think that's, I mean, I think that one of the reasons why, for example, electricity, you know, I mean, they do actually, I mean, where they buy their electricity is potentially innovative, right? I mean, so it's not, I'm not quite sure I buy in inherently to say utilities are not innovative just because that's the basis of regulation. That doesn't necessarily make sense to me.
Chris, do you think of these companies? Do you think a utility comparison is accurate?
Well, I will tell you, 6 months ago when this really started hitting the front page, I went out and got a book about the history of utility regulation. And you know, there are some parallels to the way utilities developed in this country and the way broadband is developing. But I think there are some important differences. You know, I think you can argue about, you know, electricity is electricity, and there's a lot of different elements, variables to broadband. I would also say broadband is, and I was careful to say it in my opening remarks, is not a monopoly. I mean, wireless, I think, is definitely emerging as a very potent competitor. I think one of the other things to think about is, and one of the things I've been spending a lot of time thinking about is, you know, in the land of supersized fast food and Costco's, Americans have tended to want more and faster and bigger, but maybe that won't be the case going forward. And at some point, is the consumer going to get to a point where they say, you know, is 10 megs enough for me for $25 or whatever the numbers are? So, you know, I think for a certain segment of the country, certainly, you know, cable is going to be your best and lowest cost option, but is certainly not going to be the only option.
Rebecca.
Oh, I just would agree. I think the whole debate about the market structure, I think, is still clearly evolving. DOJ had a nice submission that they did to the broadband report, I think, talking about it being a maturing market, and the notion of whether wireless is going to be a substitute, I think, is too dichotomous, obviously. And I think it goes to I think we're in agreement, the point that I was making initially about the problem, and probably a problem for the foreseeable future, of lack of disposable income in a lot of households and so forth. I think a lot of people, I think, you know, wireless won't provide the same speeds, but it'll be good enough. And I think on the utility regulation issue, I think one of the, and I don't know where this takes us, but I think a big difference between the broadband providers and what we think of as historically a standard utility is the broadband network providers are also vertically integrated. And so they're not just providing the pipes, they're providing a lot of the services that are carried over it, which I think makes the utility analogy just a little more complicated to carry through.
Yeah, just one other, sorry. I was going to say, yeah, and I think Reed mentioned this, you know, I'm not sure if we could go, if we went back, you know, 100 years or 80 years and had it to do again, we would have regulated utilities the same way. I mean, look at the state of our grid and our transmission infrastructure. I think that's a pretty bad outcome. Anyway, sorry. Go on.
No, it's okay.
Yeah, I mean, you talked about platforms also, and you know, people now talk about the internet not as a network of networks, but a network of platforms. You know, people tend to think that particular platforms, can ultimately exert lots of power. Laura, you don't think that they really will? A particular platform stays dominant for long.
Right. Well, I don't, but I guess back to this issue of, you know, why is high-speed data a necessity? Why has the government decided high-speed data is a necessity? What we've seen in the past is that the government has had a minimum, like the broadcast tier. The cable industry had to deliver the broadcast tier to everyone, and then there was a thing you could pay $30 for at the beginning, or actually it was $10 at the beginning, and that was deemed a luxury. And it wasn't the government's job to force everybody to have the right to get 30 channels. It was 30 channels until DirecTV started, and then suddenly, whoop, exploded after they upgraded Plant to 300. We have dial-up. There's still 6 million AOL dial-up subscribers. We have Earthlink. Why isn't dial-up the thing that the government wants everyone to have? Why is it that high-speed data, which is really expensive from an infrastructure investment point of view, suddenly become the requirement that everyone in the country has? I handed Scott a paper yesterday, and USC has done a longitudinal study for 10 years about people using the internet. 18% of people in this country don't use the internet, of which 40% have disconnected after using it for 3 years. So this concept that we're going to spend a bunch of money to roll out high-speed internet to households, which is going to cost the Treasury a fortune because commercially it wasn't viable, or my cable guys or Verizon or even the Dish satellite guys would have rolled it out already. We're going to spend a fortune as the Treasury rolling it out to people that may not even have a use for it. Because right now there's a backlash against the internet and people are starting to disconnect from the internet 2 years in a row. So I mean, I think that's an interesting policy question.
And it will definitely come up in the next panel also. They'll discuss it a lot more.
Yeah.
So it's a good way to set it up, actually.
Yeah, I would recommend an investment philosophy that believes that people will be getting off the internet in masses. That would be a good one.
Okay. Quote that, and don't say anything about sarcasm. But what I wanted to get out of you was, well, I was hoping to get something controversial out of you, so that was pretty good, actually.
Good.
But
Not hard with me. I'm good at that.
right. But you have feelings about even how viable Facebook is in the long run.
Oh yeah. Okay. So I think one of the things that I think is really interesting about the consumer internet space is these appear to be winner-take-all markets with 15-year lifespans. So that means they get really big, and then they go to zero. So this is really different from the physical world, because in the physical world, there tends to be something called a terminal multiple. At the end of the day, when the newspapers all go away or consolidate, you actually have a physical, the LA Times sits in this magnificent piece of real estate in the middle of Los Angeles, and they have printing presses that can get shipped offshore or repurposed. So there's actually terminal multiple values in most physical businesses. These internet businesses, they seem to, let's just use some examples. MySpace, you may recall News Corp bought it for $538 million, and for 30 seconds they looked like a genius because it was worth $5 billion, and it feels like it's on its way to zero. Not something, zero. Feels like that with AOL. The smart guy, Tim Armstrong from Google, is going to try to turn it around. But you may recall when it merged with Time Warner back in 2000, it was worth $100 billion. My Time Warner, which I covered, was worth 70. Today, in the markets, it trades at $6 billion, and I think it's going to zero. I mean, that's what the market's not sure, but it looks like it may be going to zero. He's fighting against the odds with a great team over there to try to turn it into something meaningful again with a new strategy. So one of the things about these internet platforms, and then I could say Yahoo, I could say Google if Hal's left the room, which I think he has. Google, and what the market's telling you when you look at the Google stock price since January is that its growth is encumbered by the rise of Facebook, which is the next winner-take-all platform. Because the advantage of the new platform is they start in a new technology world 10 years later with a clean sheet of paper. They don't have to look backwards and be encumbered by what was possible when Google started in 1996, and they don't have to look 5 years before that when MySpace started. So it feels to me like this concept of creative destruction around technology businesses, they don't really have barriers to entry. So the consumer shifts, these are winner-take-all markets, and then they disappear through disruption of the next big idea that's technology-enabled.
That's why I own the pipe.
And you can own the pipe, as long as it doesn't get regulated, as long as its returns don't get regulated.
Do you believe that? Do you take that sort of thing into account when you're making investment decisions, or do you think that's totally off base?
Well, actually, I do think that one of the things is that in the technology base, there's a constant revolution. And if you're not playing forward on the revolution, or you don't have strong network effects, which some things don't have, then your volatility is higher, right? Whether or not that goes exactly to zero and whatnot, I think that's a kind of a different interesting argument, because I think that part of what you could argue is that in the case of, for example, eBay and Yahoo, that despite a significant lack of innovation over years and a continued attack of the market, they preserve fairly strong values, over time. Now, you might say, if they never do any innovation, will they ultimately go to zero? The answer is probably yes. Hopefully, the management will fix that. But I do think that, again, one of the things I think is kind of interesting is when the businesses are innovating the right way and they have a platform that is a very broad set of people, and there are, one of the things I distinguish between a strong and weak network effect. So a strong network effect is I use service A and I constitutively can't use service B. Like, for example, long distance provision on a phone. I'm using one, that's one, that's not another one. Most network effects on the internet tend to be weak network effects, like instant messaging clients. So I can be using AOL, but it doesn't stop me from using Skype as well. right? So I tend to not, AOL Instant Messenger, despite, again, no innovation in it, preserves a whole bunch of people using it because a bunch of my friends are there and I tend to use it. So I still have a network effect against stopping using it, but I don't have a network effect against adopting something else. But any kind of network effect continues to allow something to play forward and to try to create at least a monowall in order to continue to play out their business. And so, I've been, my sarcastic comment of earlier is, the principal investments that I make are in the internet industry. And part of that is because I think that one way of encapsulating it is for basically a net of $5 to $30 million of capital in, you can reach 10 million and growing people in a profitable business. And then that can be a major way of engaging how people use their time. Now, for example, I think Facebook has network effects because it's where you have connected with a bunch of your friends, and the principal content that people are sharing is what's going on with their friends. So I think it's not impossible to shift it if they stop innovating, because I think these tech companies always have to innovate. I think that'll start to decline, just like how eBay has been hit. But as long as you're doing innovation, I think that it can get stronger and stronger.
So, but aren't you kind of saying then that the companies that have staying power are those that are closed networks?
No, network effects is not necessarily the same thing as a closed network. The question is if you don't have, like, for example, one of the things I tend to look for is where, like, this is one of the reasons, like, the social web is one of the things that I've done a lot of investing in, is because by nature, people interacting with each other, even as early as AOL Instant Messenger, tends to have my attention is focused here because it's focused on other people. I actually think that one of the more interesting innovations has been trying to make that social infrastructure at least, the funny thing is very open is a good strategy. It's part of how Twitter rose, even in the context where Facebook was already pretty big. And so, but that gives you a platform in which you can build a number of things on top of it.
Did you?
Can I make two observations?
Yeah.
Not necessarily on Reed's points, but just two observations, some of the thinking that I've been doing out here in particular. The first is there seems to be a real disconnect between what happens on Wall Street, what people think of what happens on Wall Street and how that may impact what happens in the boardroom and what happens in the way companies make investment decisions. And the comments I've been hearing over the last several months, and I wrote them down here, are, well, the network is already built, they're not going to stop maintaining it. Or we have no social obligation to make sure that stock prices go up and Brian Roberts gets richer. Or Comcast and Verizon don't need to access the equity markets, at least we hope, any longer. And in fact, I think in some of the reply comments, they say they've been disinvesting, i.e. buying back stock. And I think that really misses the way capital gets allocated.
I agree with that.
Your market return on equity impacts your cost of capital. And hopefully CFOs out there are sitting with a bunch of options. They could do DOCSIS 3, they could push fiber deeper into this neighborhood, they could move the upstream split, they could buy back stock, and a whole bunch of other things. And if your cost of capital, if your hurdle rate is pushed up by poor returns in the market, you're not going to invest. You're not going to invest in the infrastructure, and that, I think, is a social loss for everybody. So that's the first observation. The second observation is, and about 30% of my fund is in TMT broadly, but we do invest in other areas. And I think this has to all be taken in context. We've watched over the last couple of years, industry after industry, healthcare, energy, financial services, for-profit education, get shot in the head. And all those industries they all probably deserve to be shot at. In fact, financial services probably needs to be machine gunned. But, capital is mobile, and I can very easily, with a click of a button, buy Net Servicios in Brazil or Cable Deutschland in Germany.
Is that a threat?
No, no, it's not at all. Capital is agnostic. It doesn't have a nationality, it doesn't have a religion, it doesn't have a philosophy. It goes to where the highest returns are. And it's scary to me as an American, and a very proud American, that those countries have a more friendly regulatory regime than we do at this point.
I agree with that. Let me respond to a couple of things Reed said, since my goal is to fight with him today. Social networks. So one of the things that has surprised me the most about the internet is that network effects don't work. So, network effects are every person you add to the network becomes kind of exponentially greater. So a telephone network isn't worth very much if only he and I are on, but if all 5 of us are on, it's going up in value at the speed of light. So when we got eBay as the best example of a network effect business, marketplace, auction items, rare, hard to find, great strategic position, destroying itself by bad management. And there's this presumption that you'll bring in management, the board will follow management. They piss off their sellers. They haven't upgraded the user interface, so you can't search. You put in dresses, there's 10,000. Well, if there's 10,000 of everything, it's kind of like YouTube, it's useless. You need to curate the stuff you have. So slowly, without and I would say the distinction between Amazon, not only do they execute better, okay, that's clear, they also have physical barriers to entry. They've got, distribution systems in the physical world that give them a barrier to entry, which makes their capital spending huge. By the way, so does Google. Google spends as much money in capital spending as Comcast does as a % of revenue. So, and they have physical servers. They're the 3rd largest fiber owner. Those physical barriers to entry create competitive advantage, create barriers to entry, which we on Wall Street like. So one of the things about these network effect businesses is they elongate your competitive advantage period and your ability to bring in cash flows, but they don't actually protect you in the internet world from being displaced by the next big entrant. So Google's taking share, Amazon is taking share, new entrants are taking share from eBay now.
But aren't social networks a little bit different? I mean, Facebook, for example, I personally, I don't like the interface. I mean, they have 2 home buttons on the front page. I mean, it's ridiculous, 2 home buttons.
I
care about my friends in there.
Do you remember Friendster was all the rage? And then MySpace became all the rage, and everyone was on MySpace until Scott and I started getting on MySpace. And then all the 18-year-olds said, Mom's on MySpace, get me the hell out of here. And they all ran to Facebook, and there were very real security issues and transgressions with MySpace. But it is my view, and I'm willing to make this bet with Reed right now, that in 5 years, whether it's Twitter or whether it's somebody else, these consumers are fickle. I hate on Facebook all this damn stuff about Zynga, all these Zynga goods. They're annoying.
I would say one quick thing, if I could just jump in to Reed's defense. That's okay, because those businesses, listen, if you're at Stanford Business School today, you don't say, you know what, I want to change the world and get rich by spending 10 years and $100 billion putting fiber in the ground. You want these capital light businesses that can get up and running very quickly, and they're quick hits. And they don't need a very long competitive advantage. Whereas, $200 billion invested by the cable industry, that requires a very long payback. And
Right,
that must be a much longer sustainable competitive advantage. Sorry.
So go ahead, Reed, respond.
Well, 2 responses very quickly. So one, there could be more, but we try to keep a good dialogue going. So first thing, in terms of eBay. So eBay made a mistake in terms of how it looked at its network effects, because eBay's business in collectibles and used goods is actually about as strong as it was before, and actually hasn't been displaced at all. And that's actually where the network effect is most strong in eBay. And so that's an instance of actually where network effects do actually work, right? Okay. So the thesis that network effects don't work, that's kind of first, shot at that. Second thing is, part of the thing I think is interesting about these is I think that what happens is these businesses start in very lightweight ways, and then as they begin to get mature and get the revenue stream up, then they start investing in things that I think build a deeper set of trenches. I mean, if you only want to think about physical stuff, you can think about Google and the server farms and fiber. I think one of the natural patterns in all of these businesses is once the revenue stream gets up, they start investing in things that kind of really lay a much deeper foundation for the businesses. And so, in the Zynga case, which is, it's a 3-year-old company, right? I think what they're beginning to do is invest in much deeper tech stack in the games, right? So that it becomes harder to compete with them because you have to do a much better game because they're at that point iterating on it. And I think that phase of how these things play out is part of a good 1, 2, 3 kind of business strategy. And so that's why I'm, long on these companies and not just a investor in physical goods.
Let's take some questions before we run out of time, if there are any. Yeah, Blair.
Just a quick yes.
we'll wait a second for James there.
Just a quick yes or no question for Laura. You said the government should stay out of the markets. Do you think the government made a mistake in assisting the young entrepreneurs, Ralph Roberts and others in the 70s by giving cable access to electric poles and broadcast programming?
No.
Thanks.
Peter?
Peter Pitch. I'm struck by the broadband market, even just the wired market, having in most markets 2 competitors. My study and knowledge of utilities is that there's one provider who has a natural monopoly, rather stable situation. Government comes in, regulates, makes prices available. Is this utility analogy apt?
I mean, I think we talked about it a little bit. You know, I think one of the concerns out there is, or one of the questions out there is the cable industry evolving into a natural monopoly, i.e. they have, by definition, the lowest, you know, even if you can throw wireless into the mix, the lowest cost per bit and the fastest speed. And again, as you say, even though it's a duopoly, it's not really a duopoly in, again, all but the Fios homes. I think one of the interesting things, I haven't heard talked about much, but one of the interesting, perhaps unintended effects of this whole net neutrality debate is that, in a way, it locks in cable's competitive position. Because, you know, I think any company is going to think twice about putting fiber in the ground with even this uncertainty. You know, that may extend to how much companies pay in spectrum auctions. And sorry.
Oh, no. And I just would say, by the way, one of the things I think it's interesting in thinking about utilities, monopolies and whatnot, is actually I think technical innovation in all fields can evolve what the landscape is. I mean, if you've suddenly figured out, if you had a way of suddenly beaming wirelessly power to all the houses, right, then all of a sudden the issue of the owning the line becomes a different issue. And I think that naturally plays out. And I could see that if you actually evolved and developed genuine kind of, you know, multi-choice market competitiveness, then it becomes less of an issue.
How do you see wireless evolve? I mean, not
I
evolve,
think
but do you
wireless
see it
will
as
evolve at some point. Like I said, part of the reason why I kind of stick to certain principles about how I think about these, as opposed to arguing per se for just saying, oh, this specific regulation is the right thing for all time. It's more, this is the input that we want to have to try to maintain, right? And so thinking about kind of platforms for innovation is the kind of thing that most concerns me in this. It's better to actually get all the way to a market.
I guess,
Rebecca.
yeah, just in response to Peter's point, I think the utility regulatory model, I mean, maybe it's more than an analogy and more than a metaphor, but I don't think anybody is talking about that strict level of price control and all that goes along with utility regulation. And I think that the point that you were making is one that we've thought a lot about, which is over time, if we get to a world where there are applications that require the speeds that cable has, and only cable has except for Fios, and I think that may never come, that period may never come, and if it does, I think it'll be years away, but then you would be in a world where you may have a monopoly provider, and at that point, the government, I think, will step in.
Of course, that's also assuming
by the
nobody
way,
else
if
invests
you-
in the meantime.
Yeah.
If you're going to determine the price level for a managed network, don't you have to know the cost of capital?
Yes.
And we couldn't figure out the cost of capital for AT&T in the 1950.
Right.
Now, how are you going to figure out the cost of capital in this market?
Well, and it's going to go up, because what we saw in the middle of Title II was even threatened as the stocks were down 15%.
Well,
just a sec. So my perspective on the utility question is a little different, which is who financed it. Because normally the rules are clear. You give $1 and you get a 10% return or a 15% return. In this case, we gave them money originally for the first 40 years. Then with rate, when they upgraded their plant and spent another $70 billion, we gave them money. Their multiples used to be 10. They are now 5. Because as the government threatens to cap their return on invested capital, and to his point, when you invest $200 billion, you better have a nice long return cycle. So if the government's saying the only thing that's been growing for you is modems, but we're threatening, maybe not this year, maybe in 5 years, to cap out what you can charge, the market says, I'll go somewhere else. I have liquidity. I don't own real assets. I'm going to go buy gold. Energy. We don't. So the market reallocates capital out of something that it doesn't know how long the asset will be regulated.
I think paradoxically, if you waved the magic wand and said broadband companies are utilities with regulated returns on equity, stocks would all go up from here.
Yeah. You think so?
Yes.
I mean,
I don't know.
I think your point's exactly right, that the capital can go anywhere, and that's something that regulators in Washington need to keep in mind always. But where is there an area of investment that is both profitable and risk-free?
Right, that's the...
Yeah.
Expand on that. Why would the stocks go up?
And I'm not advocating that by any means. I certainly would not like to see that happen.
And I disagree. I think
But
they
no,
go down more.
because if the government says, as they did in the utility industry, you're blessed as the broadband provider, you're going to have a monopoly with a guaranteed return on equity. I think the stocks have priced in. It's a matter of the stocks are now at 5 times, and they should probably be in that world when you have a guaranteed return on equity.
Well, that's where telcos.
But is your point that regulations ultimately end up benefiting the incumbents? Is that your underlying your point?
Yeah.
Okay.
No, and I disagree. I think they'd go to 3, because that's exactly what a telco multiple is when you pay a huge dividend and you have no innovation.
But there's a lot of other dynamics with telco. I mean, you have
Yeah,
wireline
your business is
disappearing.
wireline. That's true. That's fair.
I think we can take one more question. Yeah, right there. Wait for the mic.
And he had a question
Oh,
too. So maybe 2 more questions.
Okay, yeah, there and there. Okay.
Ed Black, CCIA. It seems to me one of the dynamic, and I think Verizon and Fios is maybe the best example of it, is you had utility companies who basically saw the internet world and saw huge returns, big profits, and the dreams of becoming a different kind of company was there. Verizon, I think, with their investment Fios and some other technology, has actually been more aggressive in trying to move there. But whoops, the big returns from Silicon Valley comes from a combination of innovation, risk, and great execution. So you go back and ask yourself, in the carrier world, who has done all those things? Is there some innovation? Certainly. Is it the quantum and type of innovation that some of the big stars in Silicon Valley does? No. Risk, net neutrality, I think, is a good example of once Wall Street dumped on Ivan and the Fios investment, all of a sudden net neutrality became a bigger priority in the public policy scheme, because the risk tolerance just wasn't there, because Wall Street was still looking at Verizon as a utility, not in maybe what Ivan saw themselves as a new, different kind of more dynamic company. And execution, frankly, I think is not exceptional in terms of the carriers. So the dreams of becoming a really dynamic, growing, high return company in the Silicon Valley model is still, I think, in the eye of a lot of companies, and yet they're not taking a risk. The innovation isn't there, and execution is middling. And I think that's where a lot of the conflict is. There's a jealousy to be like Silicon Valley companies, and yet without the risk and innovation, the justification, our system doesn't really reward that. So instead, they fall back on dominance and a control and a lock model.
I'd add a 4th one to that, though, and it's the point that Reed made yesterday, that you invest, I forget what numbers you made, but you invest in 10 companies and you're lucky if one of them works, and that's much more difficult in an infrastructure context.
I would look at, the counterexample to that, I think, is Cablevision, which, full disclosure, we are the 3rd largest shareholder, and I have them in my home in New York. They have been very aggressive in taking their platform and adding all kinds of bells and whistles, whether it's simple things like the phone number on your television screen or with Wi-Fi overlay mesh, business services. So, I think there's a case where the company has taken risk. And by the way, again, one other interesting point here is Cablevision has more subscribers today than they did in 2003 when the Fios build-out began. And they have a 90% overlap with Verizon. So,
part of what I was saying, just to finish up, on Wall Street tolerance, I think eBay and Amazon both went 4 or 5 years without any profit. Okay, Wall Street tolerated it.
yeah, well,
Because
the
they
cable
saw it.
industry,
Sure,
only
20
had
years.
net income
Yeah,
4 years ago.
But my point on this would be, I think the lessons that we've learned from the Fios build-out is you can't take CEOs and corporate staffs that have moved their way up through a utility business and turn them into visionary entrepreneurs. They can copy the cable business, We even see it in what I would call my entrepreneurial big companies. When Rupert Murdoch buys MySpace, it dies. When Time Warner buys AOL, but it was supposed to be reversed, it dies. Because the talent that it takes that resides in Reed's companies don't stay in my companies. They don't want, so Disney just bought Playdom, it just bought Taliuka or something. Every time one of my companies buys a little internet startup, the people run as soon as their earnout is on. They don't want Disney
Well, they already
stuff.
left Electronic Arts. So.
All right, they already left. I mean, so the point is you can't actually recreate in the old economy with its kind of returns on capital and its share price appreciations, the risk profiles and the motivating factors of this little Silicon Valley entrepreneurs, in my view.
Okay, one more question.
Oh, no, it's him. He's had his tons of
All right, well, we have a question right there.
All right.
We'll do very quickly right there.
It's actually, I guess, more of a comment on Chris's comment on rate of return. Rate of return regulation only works in a monopoly environment. In any other environment, rate of return regulation can put a maximum on earnings and on prices, but that's all it can do. So when you make your comment, you're assuming the elimination of the wireless industry, the telephone industry, and all of the over-the-top competition that the cable industry currently has. I'm not sure what's appealing about that particular choice, and I would love to hear both your and Reed's reaction to that.
And again, I was trying to be probably controversial. I would be very unhappy if that happened, but I was making the assumption that that was in fact the case, that it was a government-blessed monopoly, and again, I think the other part of the comment was it just is indicative of how cheap the cable stocks are today.
But we wouldn't be going after 500 megahertz of spectrum if the government were blessing cable as a monopoly.
Right, and which they're not, and I don't think it was a complete hypothetical. Yeah.
And the thing that I'm concerned about is not per se a rate of return regulation, but a question to make sure that we try to drive the cost of data for services as the incentive to as low as possible in order to create a platform for what I think kind of what the new global competition in industry is going to be.
Yes.
Laura, thank you for directing Scott's attention over here. I just wanted to make one comment. I mean, I think that increasingly we have heard over the course of the last 18 months sort of the utility moniker being applied to the cable industry and into the telecom industry. And I think that it's been applied from the standpoint of what we should not allow them to do. But I think it's important to keep in mind that when something is categorized as a public utility, that the social contract is also that others shall not be allowed to impinge upon that particular utilities market, because it then becomes important for the regulator to assure that the utility continues to succeed. So in the 1970s, one of the issues that came up was the regulators were making sure that others could not compete with AT&T because it could impact the viability of that utility. And so what we have today is a situation where we have cross-competition on broadband from Clearwire, from wireless offerings, from satellite offerings, from cable, from wireline telephone companies. But at some point, if we define a set of companies as utilities, then I think it does become incumbent upon the regulators to determine with each and every new competitive offering whether or not that's going to impact the utility itself. And that's a side that I think gets us back to an era that really proved unworkable, whether it was railroads, telephone companies, cable companies, or whatever.
I would just say, I think you're absolutely right, and I think we may have backed into the best argument for why the cable industry shouldn't be regulated as a utility, because you can't say, nobody's going to advocate telling the wireless industry that you can't impinge on cable's broadband business. So,
Do you want the last word? Reed?
No.
Nope. Okay. All right, well then please join me in thanking the panelists.